Welcome to today's video. Today, I'm going to talk about a very interesting relationship between two entities that always exist together, right? And those two entities are risk and reward, right? I'm going to explain the close correlation between this risk and reward. Basically, we normally say that the risk is directly proportional to the returns, right? The more the risk, the more amount of returns that you can get. So this is generally the whole thing, this narrative that we always hear, right? So is this really true? And how can we apply that to investing? First and foremost, you all need to be clear that what is the rationale behind investing. Is there a reason why we need to invest? Is there uh, not any reason why we shouldn't invest? That is what we're going to discuss today, and we're going to bring in two famous concepts that are very much interlinked with each other, that actually play a very huge role in actually making our lives, right? So first, investing doesn't just mean investing in the stock market, right? You can invest in all sorts of stuff. Today I'm going to outline you all the different investment opportunities that an retail investor has that he can actually look up to, right? The one thing that you should always remember, ladies and gentlemen, is that um, you should always own assets. Assets should be the main priority for anyone, right? So if you're taking a home loan, is that an asset? No, it's not. The money is flowing out from your pocket. If you're taking a credit card loan, that's basically the worst kind of loan that you can ever take. That is also a liability. But when you're investing into stock, right? When you're investing into bonds, when you're investing in real estate, what is it that you're actually looking to get out of it? Let us try to understand the psychology behind why people invest into these assets, right? Maybe that will make you understand the risk and the reward equation that exists when it comes to the world of investing. So first, always own assets. That's the first rule of investing. Always own assets. And what kind of assets are we talking about? My definition of asset would be an asset is something that is predictive and that will continue to generate cash flows for you well into the future, right? Always own assets, not liabilities. Now, for me, an asset is something that produces something, right? That is what I consider as an asset. Just because I own something doesn't necessarily make it an asset if I'm not using it, right? So, an asset is something that will appreciate in value over time, and it will produce something for me. So, my definition of an asset is always something that correlates with production, right? I like owning productive assets rather than non-productive assets. Now, what are non-productive assets? For example, you have something like gold. Like gold has been thought to be like this age-old kind of great asset that we should always hold. You should always invest into that. Or mom and dad love holding gold. So does a modern day investor who's like living in 2023 right now, as the new year has kicked in, should actually consider investing in gold? And if not, is there a right way to invest in gold? Maybe we'll discuss that in some of the other videos, but today's video is all about risk and reward. So always own assets, not liabilities. These assets can be, some can be predictive, some can be non-predictive. So the best example of predictive assets would be something like stock, right? You should kind of like try to understand the rationale behind holding stocks. What is the attitude towards the stocks that you need to have in order for gaining a lot of capital well into the future. What is the main attitude that an investor should have if he needs to invest in stocks? He should stop viewing stocks as random things that go up and down, right? Stop thinking like a trader, start thinking like an investor. Whenever you're looking at a stock, always look at it like you are a part owner of a company, rather than you are somebody who's just investing into something that will go up tomorrow or go down tomorrow. You know why exactly this kind of attitude is needed in investing? Because there will be times in your investing career, in your investment horizon, that you will see your stock maybe go down 10%, 20%. And if you're not ready to actually hold on to these stocks during those times, believing in yourself, believing in what you own, right? So if you're not having that kind of temperament towards stocks, you will never be able to hold them. It's as simple as that. A trader does not like 10% loss in his portfolio. He doesn't like it. He puts a stop loss. Whenever the stop loss is triggered, he just exits. He always makes his loss minimum. Sometimes, it's very important for investors to go through turbulent times, periods of downturns, where they have to be patient, because always, always, always remember that patience and resilience and longevity and endurance always reap benefits over a long period of time. That is something that you should always remember. So stocks are something that produce something. Bonds are another example. Real estate, commercial real estate, guys. I'm not talking about residential or commercial slash residential. Both can be used as real estate. Depends upon what kind of asset you're talking about. For example, if you think that your house that you're living in is like an asset, it's like an asset, and as well as it's not producing something, so it may not be a productive asset. But you have two houses and you're leasing one house, the other house can be considered as an asset because that is bringing cash flows for you, right? It's as simple as that. Now, are there any non-productive assets? Yes, you do have non-productive assets which traditionally have maintained their place as some of the topmost um, investing instruments. Right, the best example for that is gold, like gold, silver, right? So some people call this the God's money. It's the God's money, right? You don't make it, it's already there. So gold and silver are God's money. Stocks and bonds and real estate are humans money, right? Real estate can also be thought as God's money, but yes, real estate, gold and silver, God's money. And gold and silver are non-productive assets, but they have they have tested different harsh moments of history. Even then, the kingdoms, the dynasties, the bigger empires that ushered in the past, all these, they have come to an extinction, but gold and silver didn't go extinct. I mean, they have always appreciated in value related to our times. So they're called as God's money. And stocks and bonds, they are people's money. Even cash is people's money, right? And is there cash is not an asset, it's neither a liability. It depends upon how you're using cash. Are you using cash for funding your business? Then it's an asset. Are you using cash for buying an iPod or maybe buying an iPad? Then it's a liability, right? Cash is just the medium for buying assets and holding liabilities, right? Cash can be used either way. It's just a means for owning these assets slash liabilities. Okay, so what are liabilities, guys? Liability is simple things that get your money out of your pocket, right? What are they? They are your home loans. They are your educational loans. See, educational loan is one loan which I really consider as an asset. Some people consider that as a liability, but it depends, right? It's like a double-edged sword. If you're going to take an educational loan, will you be able to pay it back? Are you so sure of yourself if you're able to pay it back and actually earn a lot more returns because you have taken a risk in here? The reward seems to be quite lucrative because you take an educational loan so that you can get a better education, go to a good college, get a good job, and after getting good job, you get more money, and with that money, you're able to buy assets. So maybe it's a great thing. But what about a home loan? Nobody says that home loan is actually a great way of owning an asset. You might say the land on which the house is there, that can be considered as an asset, but all the things that you're going to buy in it are all going to be liabilities, unless and until you're actually buying Leonardo da Vinci's drawings and all that kinds of stuff. They're not considered as real assets, but they're considered as liabilities. The house which you stay in generally is a liability. You have to maintain it, you have to do all the painting, you have to do the kitchen stuff and all. So that's the whole kind of attitude that you need to have whenever you're trying to look at things. I generally tend to hold as many assets as possible rather than liabilities. You can buy liabilities because you need to fulfill your desires sometimes. Like, it's not like you want to put all your money into investments and not spend anything for you. It's completely idiotic, right? But have most of your assets, have most of your money into assets, and use a small proportion of that for fulfilling your desires. Try not to hold any liabilities. Hold as few as possible, because sometimes we just don't know. I mean, we are in a bad situation and we have to hold them. But then again, always try to offset them with buying even more assets as you go forward. So that's the basic idea. Now let us kind of like look at the different investment opportunities that an individual has when it comes to investments. The first kind of investments which I really like, and if you're young, then this is the best place you can have your money. You can park your money in that, and that is a stock. A stock is basically, a stock gives you the opportunity for being a part of a business. It's giving you a first class access to the top class management of a company. So these people working in the company, they're working there, I don't want to use that word in here, but they're working their asses for you. And these people are working day and night, all day long, try to reach their deadlines, and reach the required targets. And what you're basically doing is just you're owning equity. Generally means a part of their business, right? So generally, and promoter of a company, the one who starts the company, looks at his company stock like it's his business, it's his asset. But like, he thinks himself as the owner of it, right? If somebody is a 75% holder of equity in a company, that typically means that he's the owner of the company in a way, right? So when you're owning a stock, because we do not hold a considerable proportion of our money, considerable proportion of the company, we tend to think as stocks as random things that just go up and down. Sometimes people say, well, stock is in cryptos are also like stocks, because cryptos are also going up and down. But it depends upon what you're talking about. A stock generally appreciates in value if there's an underlying company. If tomorrow whole Reliance goes extinct, do you think the stock will be there? If the whole Ambanis and all these Mukesh Ambani, which just goes bankrupt, and the Reliance industry is completely closed, some plant completely blasted us away, do you think there will be a stock market that will be there? Do you think that there will be an exchange that will be listing Reliance on the stock market? No, there's not. So just think about it. It's not a hard thing to think, but you need to develop that attitude, right? So do not always try to be in a stock just for gaining money. Know what you're holding it for. By knowing what you're holding it for, you will know when not to leave it, because people often leave things at times when they should not leave them, when they should have shown some patience. Because we have seen many cases, and we actually see that told in books, that people panicking and people taking short term decisions by panicking have often led to very, very bad outcomes for them. So it's important to know history, it's important to learn it, and we should develop our attitude towards the stocks in this way. So a great way of owning businesses. So, what are the general returns that you can expect? Well, I've met many people who say that I'm expecting 100% return of my stock in 1 year. It's like, no, really, man. I mean, that kind of returns are actually quite not possible for anybody. The typical investment returns that you can expect over a course of an investing career, if you're somebody who is not really that active in picking your own stocks, or you're not really that educated in this, you're trying to invest into the stock market through mutual funds, through other kinds of other instruments or other ways, then the typical returns that you can expect, I'm talking in context of the Indian market, not the American market, but although if you consider all the global market as well, the average typical returns in Indian currency would be around some 12 to 15%. And there's a reason why I'm saying this, guys. I mean, try to understand why exactly is the average return of the stock market is between 12 to 15. Bear in mind, average return, some stocks may earn more, many stocks earn much less than this average, but the winners always compensate for the losers. So that is the general idea. So let us kind of like try to understand the rationale behind how did I arrive at this. I mean, we know that the result is out there, but the result is actually a what we call as a chain reaction, right? I mean, it happened, we are now seeing it, but it happened because of something else. The cause was something else. What was the cause? And let us try to understand the rationale behind it. So basically, an investor has few choices. He can either park his money in FD, he can either park his money in bonds. I will tell you what are bonds as well. He can either hold stocks, and he can either hold real estate, right? So FDs are where a person gives a loan to the bank. The banks misnamed it as deposits, whereas what you're basically doing is basically giving loan to the bank, and the bank in exchange gives you some interest on that. This interest being that you're parking your money into the bank for like 1 year, 2 years, for whatever time frame you're parking the money in the bank. The reason why the banks offer you an interest is because money today is worth much more than the money in the future, because you're actually not um you're giving away the chance to use present day's money, and you're lending it to someone else. The other person must recognize that the money today is much more important than the money in the future. So because he has actually given away the opportunity of using it, and now he has parked the money with him, he should repay him for that value of time. And it depends upon what kind of interest you should give him. Typically the banks generally give 5 to 6%, I would say. This would be generalized return, and the returns are quite less, and I will tell you the reason why. The idea behind this is the banks are typically, if you're putting your money in FD, there's like, a very small chance that the whole your money will be completely be turned to zero. But there can be cases where the purchasing power of your money can be zero or maybe reduced a lot, but over time you will get the expected return that the person tells you, that the bank tells you. Okay, so there's a very low risk in the bank, because the bank is taking in these FDs from various people, so they're mitigating that risk. So basically, if you ever talk that no, I want to withdraw my FD, they will be giving you from someone else's account as well. So there's no problem in doing that. So this person gives 100 rupees, and instead the bank gives him some 5% interest, and then in the next year, in a 1 year time frame, the 100 rupees grows to be 105. He did an initial investment of 100. After 1 year, the money turned out to be 105, right? Now, what do the banks benefit from this? I mean, you might be thinking this is age old question that everybody is giving money to the bank, the bank is putting on interest. How exactly is this happening? Like, how is the bank able to give you more money than what you actually invested in and actually survive? The answer is pretty simple, guys. The banks actually lends the money that he takes from all of you to other individuals, which are corporations. What are these corporations? You might not have heard of this, but these corporations are big companies: Hindustan Unilever, ITZ, maybe Adani. I think this is very famous recently. Um is actually quite famous, Adani Enterprises. So yes, you might have heard of it. Like, Adani has taken tons and thousands of crores of loan from SBI. Now you might be knowing where exactly your money that you're investing in your bank is actually going to, in whose pockets is actually going to. So obviously the banks, because they're giving the money to the corporations, they must give it at an interest, because these people, the banks, need to give you at an interest of 5% they're offering to you. Obviously the corporations, they will give it at a higher price. They will lend to these corporations at 7 to 8%. This is generally the amount of money you will actually receive. Also, you can actually behave as a bank and give loan to the corporations through bonds. So bonds are basically loans given out to corporations. Bonds are basically loans given out to corporations. The individual may be a bank, the individual may be a normal individual investor as well. So it's very much clear. So bonds are basically loans. So if you're basically giving out you're buying a corporate bond, what you're basically doing is that you're giving him some 10 lakh rupees to the corporation and you're expecting some 78% return. If the corporation is taking money and has to return 7 to 8% of return, 7 to 8% to the bond holders and to the banks, obviously they must be making a lot of money. If they do not make more profit by turning the money that they are withdrawing from you, that means if he takes 100 rupees from the bond holders or from the bank, the corporations must actually be earning a lot of more money. They must be earning around 170. They must be earning 170 rupees. Only then will they be able to pay the bond holders, and they must be able to repay the loan to the bank, right? It's as simple as that. Now if you're looking at this whole equation, they're taking 100, they are gaining 70. Now they have to how much they have to give a 7% of that, and that would 7 by 100 of it. So that would basically 749. So that would be around, they must be giving around this much amount of money. So 13.9, right? So this much amount of money, rupees, they need to be giving it to the bondholders along with the principal. The principal here being 100 plus 70. The 70 is what they earn. 100 is what that you have given. So the 7% of that would actually be definitely be equal to 7% of 100. That would be how much? 7 rupees. So they will be returning 107 rupees to the bond holders and to the banks. And because they're returning 107 rupees, how much profit they're left with? They are left with 63 rupees of profit. Now the 63 rupees of profit is kept by the corporations, and out of that 63 rupees, some of the money is given out to dividends. You must have heard of dividends when it comes to stocks. So stocks are basically, so stocks, when they give dividends, dividends means divide and in the end. So after all the money has been given out to these corporations and to the banks, uh, whatever money is left, if some of the money will be invested into the corporations and given to the salaries of all the employees and everything, the remaining amount which is left from the profit, this is divided to the all the individual equity holders, the ones who are holding the shares, because the bond holders have already been paid with the 107 rupees. And this is the one of the ways in which you can make money from stocks. You get some money through dividends. Some companies do not give dividends at all. They are investing all the money, even every single penny that they earn as profit, they are investing into their corporations again. They're investing back into the business again. Amazon is a great example of a non-dividend paying paying high growth stock. They are completely investing every penny that they are earning into their business, right? If the corporation or the promoter, the founder of the corporation is buying some private jet with the amount of money he earned, you should stay away from such companies, right? I'm not going to deep into that. So you, in FDs, you're going to receive 7 to 5 to 6% of returns, bonds 7 to 8%, stocks 12 to 15%. That is typically explained from this, right? This whole equation. And real estate, the typical returns can actually be much larger or much lesser depending upon that. If you're owning commercial real estate, there's a probability that you can earn actually 14 to 20% return. In some cases actually they will earn even more. So if you remember all the rich people right now that we see in Mumbai and everything, most of these people have made money from the real estate, because in 1990s real estate used to be really cheap. Now it has become extremely very costly. In fact, uh, India is one, or if not the most expensive real estate. India has the most expensive real estate in the whole of Asia, because we have a very small area, we have a large population. So the amount of square kilometers per one person, right? That is quite less in India. That's one of the main reasons the land prices are soaring high in India. But generally what people buy are residential real estate. That means they buy apartments, which is a really bad idea, guys. You're building an apartment, some other builder will come and build an apartment opposite yours, some other 20 floors. So there's a lot of problems. But if you're building a very a commercial real estate, a restaurant that is as big as that, it's very hard for somebody to build that much of a big restaurant beside your house and completely take over the market share. So the greater the risk you're taking. But then again, if you're building that much of a big building, commercial real estate, what if nobody comes to your restaurant? You have to bear all the losses. So the greater the risk that you're going to take in there, the more will be the returns. That doesn't mean that you will not go, that you will go and stick your head into everything that gives you more risk, because I am very much greedy of getting good returns. The best example, the best classic example of that is cryptos. Cryptos are non-protective assets, guys. I mean, till now there is no discounted cash flow model. I know I'm using a very investing jargon in here, but yes, you can't produce anything from Ethereum right now, right? I mean, there has been talks of Amazon also putting interest in Ethereum, that this Ethereum will be actually be you can actually build a lot of functionalities on Ethereum. For example, dApps, decentralized applications, and DeFi, decentralized finance. But everything is still yet to be seen. It doesn't mean that you will just go and stick into that. What if the whole crypto assets, the whole crypto class doesn't itself survive? What will happen to your money? You're taking risk, but are you producing any return? Bitcoin is generally, I don't like it. Ethereum is something that I like. You know why? Because all these big corporations are actually taking an interest on it. Decentralized finance and decentralized applications and a lot of functionalities, for example non-fungible tokens and all of the stuff are actually being woven into this network of Ethereum. But you can't do the same thing with Bitcoin. Bitcoin is basically like a is used like a means of exchange even though it's not being used as a means of exchange. But typically Bitcoin generally acts like gold, right? It's a non-productive asset. It doesn't mean that I'm actually against cryptocurrencies. There are good cryptocurrencies out there, but very few right now. Ethereum and Bitcoin will most possibly survive. Doesn't mean that you should actually go and invest your money into that, because there's a lot of speculative stuff going on in the crypto market right now. It's a very small market. It's a very volatile market. So don't get into the market, or at least if you want to ever put some money in that in that asset class, at least try to put only 4 to 3% of your portfolio. That would be my suggestion, but it's not investment advice. Who knows, in the future Ethereum or some other cryptocurrencies can survive, but I don't know. The future is very bleak. So don't have much of your wealth into those kinds of assets. Rely on assets which already have a very big history, right? If you want to invest in gold, if you want to invest in gold, real estate is not something I can talk about. There are real estate investment trusts that actually act like stocks, but I'm not going to talk about that in today's video. But if you're investing into gold, do not buy physical gold. There are a lot of makeup charges. Try to buy gold ETFs, right? Nippon India gold ETFs. You can trade them. You can actually, accumulate them, but do not expect magnanimous returns going forward. Gold is actually a very, very short-term bad provider. People are even still debating that, gold is generally not as diversified of an asset that we thought it was, because generally when the stocks fall, the bonds actually rise. So you're trying for hedging your portfolio, so that your stock portfolio, if it goes down, your bond portfolio will make you survive. But generally gold also tends to be, doing very bad during financially very panicking situations like COVID time. The gold price also went down, so we just don't know what exactly is happening with the gold. So maybe if you're in your late 40s and 50s, you can start thinking of putting some of your money in gold. But if you're in early 20s, the best way would be doing, if you're still in the start of your career, the best way to diversify your money is to put your money in stocks and maybe in some in bonds. But as you grow up, you should start owning hard assets. Maybe decrease your stock portfolio, maybe like 50%, and remaining of the money you should start investing in bonds and buy hard real estate. And maybe that will be a topic for another video. So that's it for today. Thank you so much. If you like, please like, share, and subscribe.